into a look at investing, and we are very happy to have back Dave Edwards, President, Heron Financial Group. Dave, welcome.
Good afternoon, Kathleen.
Now, you've been in the financial services industry for many years. You've worked in Lower Manhattan. We want to start with your bike tour.
Absolutely. I'm a lifelong native of Manhattan and survived many hurricanes, blackouts, riots over the years. And obviously you always want to be cautious in a storm environment, but Monday afternoon around 4, I took a bike trip down the west side of Manhattan to check out preparations for the storm, and I was very impressed by the city's proactive stance, doing the best they could in what clearly was going to be a tough situation. Took the exact same tour at 9:30 Tuesday morning, and the difference was there was a bath ring. The length of the Upper West Side, the length of the west side of Manhattan, you could see about a 4-foot-high oily smear on the buildings downtown. And where the entrance to the Brooklyn Battery Tunnel was, there's now a lake. And that's going to be a big problem for New Yorkers in general.
True, but you found an innovative way around it. Tell us how you got to the studio today.
And today I took a look out the window and observed that the streets of New York are paralyzed by traffic, so I hopped on a scooter and came over on that way. And if I could say anything to anybody listening from outside the New York City area, please don't drive a private car into Manhattan for a couple days. Please find some other way of getting here.
Okay, and you don't endorse any scooter companies, right?
Then the streets were jammed as I walked down from the Upper West Side and then along 59th. I was so glad I wasn't even thinking of driving anything. You heard part of our conversation with Dick Grasso, former head of the New York Stock Exchange, and asked about if these recent events have sort of hastened the demise of the floor trader and the New York Stock Exchange as a physical place, and are they giving more strength to the move towards electronic trading? I know you have a lot of skepticism about electronic trading, Dave.
No. There's I have no skepticism with electronic trading, and the bottom line is the era of the physical floor at the NYC ended some time ago. It's now a studio backdrop for all the financial networks. There was certainly no reason why the New York Stock Exchange could not have traded Monday, Tuesday, likewise NASDAQ. But Dick Grasso made the very important point that it's not about the technology, it's about the people.
Who operate the technology.
Exactly. And my firm was open for business Monday and Tuesday, but I felt no compelling reason to trade until things calmed down a little bit. And it's the same thing after 9/11. We had the markets closed for 4 days, and that was totally fine. Let people digest the news, a little bit of circuit breaker, and move on.
Does it make things a little bit more difficult for some money managers today?
The lesson of 9/11 for any firm that was paying attention was that you need to come up with contingencies that assume that you can't get to your physical office, whether it's in Midtown Manhattan or Los Angeles from an earthquake or Boston from a typhoon. My firm was prepared. All of our firm critical systems now exist in the cloud. Everybody worked from home the last couple of days with a laptop. They'll come back to the office tomorrow. No big deal for us, but then again, we're relatively high up in the city.
Now, there is something that is scaring you a lot, and it's appropriate to talk about it on October 31st, Halloween, a fun, scary day.
Yes.
But you think this could be less fun for markets and investors?
I'm heartbroken that they canceled the New York Halloween parade, but it's a good decision. The police have been up for 72 hours straight. The markets go up when investors have certainty, and markets go sideways or down when they're uncertain. We always see a big gut sell-off whenever there's a bad event. And regardless of the outcome, at least on November 7th, we should have a good sense of what's going to happen for the next couple of years. My nightmare scenario is a hung election, which could easily occur if, for example, there's a recount in Ohio, and we don't know who the president is for 2 months. That would take about 10% off the stock market.
Wow. But would it be just a temporary 10%? It would be no fun to write it down. It might be a buying opportunity if you're a bull, I guess.
It would be a buying opportunity. Certainly, we would not be sellers in that environment. However, since July, any new cash that's come into our firm, we've just left it in cash. We don't have good information to make good decisions, so we just have to wait.
Well, are you suggesting that when the uncertainty is resolved, either way, that all that cash will go back into the market?
I think you'll see a post-election pop. Right now you have two candidates that have dramatically different visions of how the country will be run starting January 26, and that applies to tax code, fiscal policy, where we spend money, how we handle Medicare, how we handle health care. I'm a small businessman as well as an investment advisor, and I would love to know what my insurance situation is going to be next year for my employees and what my tax situation is going to be. I don't know, so I just have to wait. multiply that by tens of millions of businesses across the country. Everybody's sitting on their hands waiting, and then they can take action, hopefully, November 7th.
Now, you have cited, we were talking before the show, a recent poll which showed that 85% of investment advisors favor Mitt Romney.
That is correct, and surprisingly, I am not one of those advisors. I'm actually a student of American history, and so I've been tracking presidents over time. And if you kind of want to use Franklin Roosevelt as a A president and George Bush as a D plus president, we actually rate Barack Obama as about a B minus. He's done some things well. There's some things he could have done better. What concerns me greatly about Romney is the tax plan that he's proposing, which over 4 years would subtract about $5 trillion from tax revenues and add $3 trillion in spending. And it's not mathematically possible to make that happen and try and reduce the deficit at the same time. And to propose such a plan, with a straight face, is to perpetuate a giant fraud on the average American, and I have a big problem with that.
Okay, we're going to continue our conversation with David Edwards from Heron Financial Group as an investment advisor who doesn't support Mitt Romney and is worried about his tax plan. We're going to ask him more about that. Certainly, Mitt Romney, if you're here, I'm saying, I can make it work, Dave. So we're going to dig into this deeper. Also, his view of where the market goes after the election and where we should put our money. That's coming up next. David Edwards is our guest, president of Heron Financial Group. David, you were saying that you are really, you do not believe in the least that Mitt Romney's plan for tax reform and is going to work. It's going to bankrupt the country. But his claim has been all along that he can eliminate enough deductions, he can eliminate loopholes, and that's how he's going to make it work. And the Wall Street Journal had an article, for example, recently saying that he made it work in Massachusetts, more or less.
Well, one of the interesting things that I've observed, and I'm at this time of the electoral cycle spending daily an hour or two on Real Clear Politics, which conglomerates every single article from every single news source. And one of the things that's interesting this go around is that the media have become very partisan. So if they support Romney, they're going to write positive Romney articles. If they support Obama, they're going to write positive Obama articles. And that's not very useful anymore. Media is supposed to challenge and question and not simply be a cheerleader. But the very simple reality is that you could save about $800 billion a year in the American tax code if you eliminated all of the deductions, starting with the home mortgage deduction, followed by the capital gains preferential treatment, followed by tax breaks for insurance, followed by many of the basic ones, charity gifts, for example. But that's not going to happen. It's just not going to happen. There's too many people that have built their lives around certain chunks of the tax code. And in fact, it would probably knock 15% off the value of the U.S. real estate market if you took away that tax deduction. So what's left is cutting very tiny programs like, PBS, for example, public broadcast service, $8 million a year.
What about corporate tax reform?
That would be really impressive if companies that are currently based in Bermuda and end up paying effectively little tax were actually obliged to pay the same tax that my company has to pay.
So that's what could make Mitt Romney's plan work?
But I don't think that would happen in the Mitt Romney.
That's conjecture.
Yeah, it is conjecture, but it would be remarkable. And so you have to look at things as they are and say, well, we're not going to give up those $800 billion in deductions. I suppose we could slash Medicare dramatically, or any kind of family support entitlements for education, for example. That would be pretty brutal for most Americans.
Whatever happens, we have to face the fiscal cliff pretty much immediately. So many strategists are saying now that this experience with Sandy will actually make it more urgent and easier to come to some kind of bipartisan agreement. Has the landscape changed?
I hadn't even thought of that. So my gut reaction is no. But what is interesting is let's say we have a scenario where Obama is still president in January 2013 and still controls the Senate, which, going by the Real Clear Politics poll of polls, is kind of the likely outcome at this point. We'll know for sure in 7 days. On January 1st, all those old tax cuts are eliminated. It goes back to the old rates. Obama doesn't need to do anything at that point, and the deficit goes away pretty rapidly. because we have a dramatic burst of tax revenues. The economy would shrink about 5%. That wouldn't be good. But the deficit would start to shrink dramatically. So I believe that will be the moment where some serious tax reform could be made, because the Republicans will be desperate to claw back any of the privileges they've experienced over the last 8 years.
Claw back the privilege? I don't understand what you're saying.
The preferential treatment for capital gains is
sure.
a privilege. Getting hedge fund revenues taxed as capital gains, not income, is a privilege, or a preference, let's say. That's probably a better word.
So what are you telling your clients? Because we're going to have either Barack Obama or Mitt Romney in the White House. In terms of investments, what does it mean for your clients?
We told our clients back in September that, well, all that was left between now and the election was the debates, and Obama was clearly a better public speaker than Romney, so that was pretty much game over. Boy, were we wrong after the first debate. That was quite a shocker. And my analogy to my clients was, yeah, it's the third round of a prize fight. One fighter is ahead on points. All he wants to do is get through the round in one piece. The other guy has nothing to lose, is all in. So that dramatically changed the polls with a month to go. And Obama has made some ground back since then, but still, it all boils down to Ohio. And really, it all boils down to the divide between the cities of Ohio, which will likely go Obama, and the rural part of Ohio, which will go to Romney. So I've told my clients we simply have to wait until we get to November 7th, and we know who the president's going to be, and we know the composition of the Senate.
So so then your strategy is what? But let's say what if you're wrong? What if Mitt Romney wins? It's a very close race. There are a lot of polls that are close. Mm-hmm. There's a few days left. What if Mitt Romney wins? So what's your strategy?
Then we would have to actually go back and look at our current investments, because right now we're oriented towards an Obama win, and we've been in that posture since the middle of the summer.
In what sense?
Well, if he truly plans to spend $2 trillion on defense spending, right? I don't think that's a good use of the national budget, but yeah, we'd have to look at that sector, okay? And I think, yeah.
What about infrastructure spending? Because I think that's one of the things that Vonnie was just touching on. That with all this damage, Congress may be in a more of a cooperative mood, a more bipartisan mood when it comes to allocating money to rebuild. What would that do for what companies would be in favor then?
It would be awesome to see some bipartisan agreement to rebuild infrastructure. We have 50-year-old circuits in our subway system; those had to be replaced. That's going to be fixed at the state and local level. I don't see any prospect of big national spending for highways or bridges.
Because the deficit problem is so
the deficit problem
huge
remains,
right now.
And I don't see that the political deadlock changes in Washington.
Is 2013 a good year for stocks?
It could be. What would make me maybe cautious on that is 2012 has been a great year for stocks. Nobody would have thunk it back on January 1st when we said 12% is a reasonable guess. Even now with the recent sell-off, it's up 14%. So that takes away a little bit of the thunder from the next year, and then also we're looking at relatively flat earnings growth. The good news is consumer spending is now on the upswing, and that will support stocks.
Okay. Well, Dave Edwards, thanks for joining us. We'll let you scoot out of here on your scooter.
You betcha.
And happy Halloween.
Thank you.
He's president of Heron Financial Group.